we've seen what happened in 2008 when the financial crisis hit a number of countries, especially in the West, and what it did to the real economy as a result of that. So financial markets are the lifeline of an economy. They spur economic development and growth in the real economy by directing capital to creditworthy companies. Financial markets are important for promotion of domestic savings, investments, and consequently economic growth. They are conducive to the long-term development of a more stable financial system. And finally, emerging economies with developed financial markets will integrate more smoothly into global markets. And therefore, obviously, financial markets are an extremely important aspect of the entire economy, as we have seen. We have, as I said, a very distinguished panel who will address a number of issues on this over the next hour and 15 minutes. To start with, I will start with my first panelist, Andrew Shung, who's the president of the Fung Global Institute. I will start by asking Andrew for his analysis of the key issues that financial markets in emerging countries need to address to look at it from an efficiency perspective and from the ability to attract investors. So, Andrew, up to you.
Thank you very much. I wanted to follow up on what Mr. Subir was talking this morning about the global environment and the financial architecture. And I also want to, follow up on Ronnie. Ronnie would have scared you quite a lot if you attended just the panel before. But the issue here is really this. I think if we're really talking about the emerging markets, should the emerging markets improve their efficiency, increase their transparency, deepen their financial markets? Absolutely, right? And this is not just for the foreign investor. This is really about their domestic investors. I think that's absolutely the crucial issue. And one of the reasons why some of the emerging markets that opened up their markets earlier and that saw these spectacular ups and downs are, markets like Malaysia, Turkey, Thailand, Indonesia, Philippines, who went through this very, cyclical stuff. And so, the experts around here probably could describe this much better than I do. Even though I'm a former regulator, and to preach mother's pie, I'm all for it. Higher accounting standards, higher regulatory standards, higher disclosure standards, better corporate governance. Nobody can argue against that. What I really want to put this is in a context. We need to understand the context that we're in. The context is that the emerging markets are now moving into an environment that historically has never been as distorted as from theory as we can think about it. We have the lowest level of price of capital, zero interest rates, which means that emerging markets, asset markets are very bubbly. In advanced economies, we have a huge debt overhang, and bond markets are, in my view, unsustainable at such low interest rates. So that if they have a policy reversal, there could be very, very difficult issues that we need to manage. We still have huge financial lack of financial inclusion, particularly financial repression, because emerging markets in an environment of global low interest rates have been unable to raise interest rates substantially, which means that the poor cannot necessarily get resources and borrow, whereas the rich can do so. And particularly in countries like China, they're struggling with the difficulty of getting interest rates back to what would be considered market levels. So there are huge macro policy environmental issues that are addressed not at the foreign investor, but actually how to redress the domestic investment community. If you were to look at the last 30 years, particularly in emerging markets, a lot of individual investors have actually left the stock markets because they have actually lost money. and so to restore the better corporate governance, higher dividends, better sort of disclosure, returns, etc., is absolutely necessary. Now, what is the context of this? The context is that the old theory was that money should flow downhill. Rich countries send the capital to emerging markets. That theory is completely 180 degrees wrong. It's the money, the poor are lending to the rich. Now, and at an environment geopolitically in which the rich countries owe the emerging markets and run a zero interest rate or near zero interest rate policy to try and reflate their domestic economies. I totally understand why they do it, but in the short term, there are bubbly effects on the emerging markets. And if the interest rates is reversed in the advanced markets, the shocks to the emerging markets could be quite large. So managing that is a huge, very complicated task. You need to get your interest rate right, you need to get your exchange rate right, you need to get your prudential policies right, and you need to get your regulatory policy right. That is the huge lesson of the European crisis and the Asian financial crisis. Now, just to show you why I think this is very important, and it's why I'm not discussing the matter in detail, because this is so critical. The big lesson from the European crisis is that the banks hold large sovereign debt, and that when sovereign debt interest rate rises, the sovereign debt price collapses, the banks become undercapitalized. So then you get very overstretched, and some people say insolvent sovereign governments bailing out insolvent banks who borrow the money, recapitalize, and invest back in the sovereign debt. It's an unsustainable situation. And this is something that our European friends are dealing with, mainly through the central bank expansion of the balance sheet. Now, if you were then to look at in Asia, you say that Asia is doing much better. Not necessarily. Asian banking systems throughout Asia, right from Japan downwards, hold large amounts of government debt. And so if the interest rates of domestically were to rise, guess what would happen? Very similar to the European situation. And why is there lack of financial inclusion? It is because if you were to look at the structure of the financial system in Asia, there is lack of institutional investors, and there's shortage of long-term pension, insurance, and private equity funds. The banking systems is anywhere 70 to 90% of the financial system. And so it's all short-term funds financing long-term investments. But what does the real sector really need today? It needs, number one, it needs long-term investment in infrastructure. It needs better lending to SMEs. It needs trade finance, and it needs inclusive finance. All of which the present financial system is not totally geared towards, because to a large extent, the old model was, if it was good for Wall Street, it's necessarily good for Asia. That, even Wall Street's rethinking its business model, and so Asian banks, Asian asset managers, and Asian financial systems, capital markets and regulators need to rethink the game. And that's the challenge facing emerging markets today. Now, I don't have a simple solution for this, but something's got to give, and that's an issue that Subir and Ronnie has talked about earlier on, so I won't go in. My good friend Subir would be the best person, since he just left the central banking profession.
So if I can just take a follow-up on that, how do you get long-term investors into the market, and how do you get money into long-term bonds and
well, you need to do this. You cannot build pensions without government regulation, right? For example, if you really look at Malaysia and Singapore, why is Malaysia and Singapore financially much more developed than, let's say, the rest of ASEAN? to a large extent, it was because in 1951, the British created these Employees Provident Fund, right? So that every worker will have to contribute 5% of their wages, and the employer contributes 5%. And today, the CPF and the EPF are very deep pension schemes which hold a lot of stabilizing resources to finance the infrastructure development. So Malaysia, Singapore was able to move into middle class very, very rapidly without having problems of financing infrastructure depending only on the banking system.
Okay, let's move to Mr. Subir Gokarn, former Deputy Governor of the RBI. Mr. Gokarn, what kind of economic policy environment do you think is required for the development of financial markets, especially in the emerging market?
Well, first, of course, let me begin by thanking the organizers for inviting me to speak at this, participate in this panel. I think in the spirit of this movement, this initiative, the first principle, the common underlying principle that we have to keep in mind very explicitly is that financial sector development is not an end in itself. That it's not the metric of financial sector development is inadequate. It has to be seen in terms of what it's doing for growth, perhaps in terms of the improvement in the aggregate, the size of the pie, and as Andrew mentioned, what it's doing to service the needs, the requirements of specific constituencies, each of which has a stake in the growth process. You can't have a situation where growth is going to be sustained if only the needs of only a few constituencies are being met by a financial sector, which is then sort of ignoring or not able to service the needs of the others. So I think that's a really fundamental principle that we have to sort of use as a platform for this discussion. Now, having said that, how do you then create a policy framework, a policy environment which actually facilitates this? The first, I'm not going to do a sort of exhaustive list, but just highlight perhaps three aspects of this. The first is very clearly macroeconomic stability, and I think there are two dimensions to this. One is, I think, relatively unambiguous, which is the focus on domestic stability. Why is this? Because markets prefer or function better in stable environments. The reason, I think, is very clear, that financial markets move extremely fast. Adjustments, resources can be reallocated in an instant. And the minute there is a sign of instability, things move. So the concept of overshooting, I think, is very important. So stability is at a premium. More stable, more predictable environments tend to facilitate development of wider and more reliable financial markets, more efficient financial markets. So that is, I think, a policy commitment which is critical for financial sector development. And the risks and the costs of not providing stability are essentially that markets tend to focus on the very short end of the spectrum. So the long-term needs of the economy that are actually growth facilitating are often sort of ignored. The less certain or less unambiguous dimension, this is what Andrew mentioned, which is the external side. There is clearly a paradigm shift going on in the global debate. The notion of completely open capital accounts has certainly been challenged, and I think broadly been seen to be unrealistic in the current global configuration. But what replaces it is not yet very clear. How far do you move down the line to managing capital accounts? How do you do it through price measures or quantity measures or some hybrid? Those are, I think, issues which are not yet resolved, and I think the debate needs to focus on what the most efficient way to do this is. Is it country specific? Are there some broad principles which you can apply? And that's something that that people who are looking at this issue need to focus on. But the need to provide some buffer to domestic markets from external shocks, and that need is now clearly and widely recognized. So the question is of how to do it so as to not go overboard in terms of protecting domestic markets. So that's the macro side of it. So stability in terms of domestic environment and some buffering against external shocks. Moving to specific constituency needs, let me focus on the issue of infrastructure, because I think that's critical to development in any sense. And Andrew's point about how the creation of a very sort of robust domestic investor base helped infrastructure development in Singapore and Malaysia is exactly to the point, which is that if you have a domestic investor base which actually has an appetite for long-term assets, this is what creates the demand for the kind of financial products that infrastructure investment depends on. Banks cannot fund infrastructure. Banks are inherently short-term borrowers, short-term lenders. So you're really stretching the banking system if you try and use the commercial banking system as a way to finance infrastructure. So what you need are either specialized institutions, which are one way to go, but to broad base the investment, the flow of funds, markets through bonds are far more effective. I think that's an objective which many emerging economies are trying to meet with sort of varying degrees of success. But very important requirement is that that money that is committed to long-term funds, pension, insurance are the two obvious channels, is made available. Now here I think there is a fiscal dimension, because if the government is a big borrower and it borrows to finance its own consumption expenditures, that's really very literally crowding out the opportunity for funds to move into infrastructure. So the government can actually be an effective intermediary, term intermediary between relatively short-term investments and relatively long-term commitments if it has the fiscal space to do so. If it runs narrow deficits or even surpluses, it does have more space to channelize domestic borrowing into long-term investments. If it has a large fiscal deficit, it uses up those funds to finance consumption, therefore has less leftover of investment. So I think that's a very important macro dimension to the infrastructure funding problem. There are many other issues, but I just want to highlight two or three. The domestic investor base, as I said, is very important. The second part of it is the creation of the market. Markets are effective when there's a lot of trade going on. People have to be buying and selling all the time. And you don't typically have that kind of environment in emerging economies in the debt markets. You have that in equity, as you've seen over the last 15 to 20 years. But debt, not so. And I think here the need for some sort of a backstop, sort of perhaps an artificial secondary market in whatever form. We've seen this mechanism work very effectively in the US context. Of course, they've got a bad rap now, but I don't think we should underestimate their contribution to the development of debt markets historically. So pooling or combining the development of long-term investors in the economy with a provision of liquidity through sort of assured secondary market, I think is a very important part of this development. When we're talking about inclusion broadly, that is servicing the requirements of constituencies such as small and medium enterprises or even household enterprises, which is, I think, really part of any inclusion strategy. We have to find ways of pooling very small ticket size lending, because that's essentially what this is. And it's very difficult for banks to manage this or financial intermediaries to manage this efficiently. Pooling them into larger aggregates which can then be sort of securitized or the risk distributed, to create marketable instruments out of this. I think in the Indian context, we had a relatively high degree of success when the retail industry expanded, auto loans, housing loans and so on. There are of course constraints, there are also risks associated with this which need to be managed. You can be a little lax on regulation or you can be overzealous on regulation and as a result create problems for the market. That's a learning process. That's something we have to learn as we go along. So overall, I think the balance between stability, which is often seen as stifling, but I think in the aftermath of the crisis, an absolutely necessary requirement, and the ability to service many niche requirements simultaneously is, I think, the way in which financial markets help the growth process become sustainable. And the policy environment really combines macro and I think well-designed kind of regulatory mechanisms which are recognize risk and try and mitigate it. That's a huge challenge. You know, risks are often underestimated or not even recognized, and that I think requires great skill and high sort of levels of scrutiny or watchfulness on the regulators' part.
So just as again a follow-up on that, and clearly one of the aspects which has been mentioned is the domestic investor base and long-term funds, and clearly India has an underdeveloped bond market and a corporate bond market. What do you think are some of the things which we need to do to get that going?
There are fiscal issues, which is the tax treatment of bonds. There are market trading or market sort of liquidity issues, which is, are there enough trades to bring other people into it? So there, I think the secondary market development is important. Even if it's propped up, I think it's important. There is the issue of coming to domestic investor base, development of the pension. That's happening. That's something. That's a process that's very much in progress. But it's not happening fast enough to sort of meet the requirement that we're talking about now. So there you have to think in terms of bringing foreign funds in to help this, to supplement this. But then you open it up to the kind of risks that we've already talked about. So there's a balancing act there.
Yeah. Let's move on to Olivia. Olivia is the Managing Director and Head of Emerging Markets for China Investment Corporation. So if we can have some perspectives, Olivia, from you in terms of how CIC has, what has been its approach to emerging markets, and what is the guiding factors that you all have looked at, and what kind of improvements do you all look for in emerging markets as you all go more into emerging markets? Great.
Well, let me preface this by saying that this is going to be my personal view rather than the CIC official view. In terms of CIC, we're the Sovereign Wealth Fund of China. We have a corpus of 500 billion to invest. Part of it is invested in the domestic financial services sector, and part of it is to be invested overseas, globally, both in the developed markets and in emerging markets. In terms of how we're set up, we're like any other institutional investors. So short-term products like public equity, fixed income, as well as long-term investments in private equity and in direct investments are all part of our asset allocation. In terms of what we look for, I think we are looking for long-term, sustained, attractive financial returns. We don't seek to actually control the investees. We don't seek to have operations influence either. So from our perspective, in terms of financial markets, capital markets, it really should be a platform or a vehicle for good companies, for growth, for value creation to be achieved, and for bad behaviors such as bad governance, fraud, speculations, and et cetera, to be curbed. So from that perspective, if you look at the global emerging markets, the financial markets is really much shallower as compared to the developed markets. So if you take US, UK, and Japan, their equity capital market capitalization is almost the same size of their GDP, and their bond markets is actually almost twice as their GDP. It represents a much deeper, much more liquid market. Whereas if you just put the BRIC countries together, their equity capital market capitalization only represents about 45% of their GDP, and very similar number for the bond market. So it's an undeniable fact that we face much less liquidity, a much shallower market investing in the emerging markets. in this instance, what do we do as financial investors? I think also because we're not policymakers, what I, as an observer and user of the market, would recommend emerging market countries do is, on the one hand, building your own robust, sustainable financial markets by various measures, and I can go into more depth, but maybe not as much depth as Andrew and Kabir. But I think, on the other hand, it is important to leverage the capital markets of the developed markets. I think that all of us, India has examples using London and Singapore as offshore financial markets. Good companies go there, raise money with much more success than perhaps they could do in India. Brazil has used the US market very effectively, so much so to a point that in 2008, their average daily trading volume in the US, in NYSE, is more than 50% of the entire Brazilian company's average daily trading volume. China has used Hong Kong very effectively. So I think that on the issue of being able to not reversely import contagions of the over-leverage issue of the developed markets, you must learn to use them so that good companies actually can be supported.
Thank you. Moving to Inam, who is the chief economist for Finansbank in Turkey. Inam, you've had experience in Turkey with the financial crisis. What have been some of your learnings from the financial crisis in Turkey, and how did Turkey deal with that with regard to its financial markets?
Thank you, Mr. Chairman. Well, at the outset, I should begin by saying that I'm actually a big fan of what advanced economy central banks are doing right now. This is a rare pronouncement from an emerging market representative mostly, but I really do admire what they're doing. I am happy to see Fed printing lots of money, actually. I am happy to see Bank of England and Swiss National Bank doing much more than what Fed does in terms of expanding their balance sheets. And I'm also happy to see Bank of Japan rejoining the money printing party. The reason I'm happy is that what these central banks are trying to do is to reflate their economies and support global economic activity by extension. And this is something that is needed in the current economic environment. I mean, would we rather see, for instance, these central banks standing back against the face of huge aggregate demand shortfalls? I don't suppose so. I think what they're doing is supportive of the overall economy. And I, for one, think there is a lack of monetary stimulus in at least one region, and that happens to be the Eurozone. I would wish a European Central Bank were more like Fed, Bank of England, and Bank of Japan, so on. Now, the benefits of these huge balance sheet expansions notwithstanding, of course, these are problematic for emerging market economies. Problematic because of the sheer size of the figures that we're talking about. If we just look at what the Fed has done since 2008, the Fed's balance sheet quadrupled since the end of 2008. And by quadrupled, what I mean is it expanded from $800 billion to more than $3 trillion right now, an expansion of more than $2.2 trillion. And this is almost 3 times the GDP of my country, Turkey. So the emerging market financial systems could very well be overwhelmed by the amount of the liquidity in the global financial system. And the channels of this overwhelming are well documented. One of them is the real exchange rate appreciation, which would lead to widening current account deficit. Another one is the rapid credit expansion as the banking systems are transmitting this global liquidity to domestic financial systems, domestic actors. And again, the result of that rapid credit expansion is wide current account deficits, inflationary pressures, and asset bubbles. And also, if we're talking about commodity importing countries like, again, Turkey, the added burden is higher commodity prices, which would, again, lead to wider current account deficits and also higher inflation. Now, against these adverse outcomes, what can the policymakers do? There are a number of alternatives. One of them is, of course, just sit back and do nothing. If you're running a current account deficit, you're running a current account deficit. So what? There is liquidity to finance that, and you can just run a current account deficit as long as you can finance it. To me, this is not an option because, as Mr. Schenk put so articulately at the very beginning, the policies in the advanced economies might just reverse. And the larger the current account deficits, the nastier the aftermath of those policy reversals will be. So we should look at doing something. We should look at the options of doing something. One of them is, of course, to limit the extent of the capital account mobility, capital account liberalization, implementing capital controls. There are some countries who are choosing this route. Of course, there are episodes of success, episodes of failures, but this is one option. Another option is to remain perfectly within the confines of full capital account liberalization and choose other measures. And this is where the relatively novel policies of Turkish Central Bank come in, and I would like to elaborate some on those. Of course, what I'm going to mention, the policy tools that I'm going to mention are not invented by Turkish central banks. These have been around for a long time. In fact, some of them have been around for such a long time that they are actually now old-fashioned policy tools, but there are some valuable insights still. Now, the first element of the Turkish Central Bank's policy framework since the global financial crisis has been to move away from relying exclusively on a single policy rate and instead using an interest rate corridor to manage short-term interest rates for the interbank market. Now, this corridor allows the Turkish Central Bank to push short-term interest rates towards the lower end floor of the corridor at times of strong capital inflows and fight excessive appreciation pressures. And also when there are stops or deteriorations in risk appetite, and when the capital flows slow down, the Turkish Central Bank can push interest rates towards the ceiling of the interest rate corridor and stabilize the currency, fight excessive depreciation pressures. And then the other leg of the policy framework is relying on macroprudential tools. The instrument of choice for Turkish Central Bank is the required reserve ratios to limit the liquidity that the banking system has at its disposal to finance lending activity. Now, when the interest rates are moving towards the floor of the interest rate corridor, that runs the risk of loosening monetary conditions for domestic actors as well. But if the central bank is rationing liquidity for the banking system through hikes in the required reserve ratios, then the result should be a slowdown in lending activity. Now, the Turkish Central Bank put this framework into action at the beginning of 2011. And at that time, the credit growth in Turkish banking system was running at a rate of more than 50% in annualized terms. Of course, Turkey is going through a process of financial deepening. The credit market in Turkey is not as deep as it is in the Western world. But still, when we're talking about 50% growth in a country where the private sector debt is more than 50% of GDP, we're still talking about very fast credit growth. So the central bank felt compelled that it should slow down that credit growth, and they hiked the reserve requirement ratio significantly through 2011. At that time also, the current account deficit was running at an annualized rate of 10% of GDP, even more than 10% of GDP. And that was partly due to the appreciation pressures that lira was facing. And to fight those, the central bank pushed interest rates as low as 1.5% at times, which would mean that for carry trade investors, there would be no incentive at all to borrow in hard currencies and invest in Turkish lira. So this helped ease the appreciation pressures on the currency. Now, the scorecard is, I would say, a mixed one, not least because the markets took some time to adjust to the new policy framework, and the impacts of this policy framework were felt with a lag. As a result, towards the end of 2011, Turkey earned the dubious distinction of running the second largest current account deficit in the world in absolute terms. The gold medal in that category, of course, went to the United States, but in relative terms, relative to the GDPs of individual countries, Turkey was doing much worse than the United States at that time. But as 2012 progressed, the central bank's policy framework turned out to be more successful. As of end 2011, the credit growth is running at an annualized rate of around 16%, down significantly from more than 50%. And the current account deficit to GDP ratio is down to 6%. And in fact, if one excludes energy imports, Turkey is now running a modest current account surplus as of end 2012. So obviously, it's not up to me to pass definitive judgment on the success or failure of the policies of Turkish central bank. It's too early to tell, to be honest, because there have been other factors at play that allowed a Turkish economy to achieve a soft landing, reduce its current account deficit, reduce excessive credit growth without shrinking the economic activity. But still, I would say the scorecard of this new policy framework is not bad, and it's my hope that this could be a contribution. The Turkish experiment can be a contribution for other emerging markets, other emerging market policymakers to deal with the capital account volatility. So to sum up, I would agree with Mr. Sheng about worrying about the consequences of policy reversals in the advanced world. And I think the way to reduce the costs of the aftermath of those policy reversals is to lean against any bubbles right now, rather than choosing to clean up the aftermath. And I think Turkish experiment is one way of trying to do that.
Thank you for those remarks. One area which we've really not talked about is financial literacy. And especially in the emerging economies, that is extremely important if you want to especially widen the investor base. How do you actually reach out in these large countries like India and China and actually bring more people into the financial system in that sense? Andrew, any thoughts on that?
Well, I think for large countries like China and India, teaching financial literacy in schools is a must. Because I think that we have not realized that the ability to understand what you buy, what risks you take, is very fundamental. And so you don't teach these guys. They come out and start a job. They have no understanding what they're buying. So you then tell them caveat emptor, and then they get into deep water, right? So I'm a great believer that financial literacy begins in the schools.
And what can regulators do, Mr. Gokarn, to actually enhance financial literacy? Because we have a population which has gone through schools but is not yet financially literate. But you still need to educate those people. And what role should the regulator be playing in the whole area of financial literacy?
I think the sort of most direct regulatory approach to this issue is not, I think literacy is perhaps a little too narrow a definition. It's really awareness. It's financial awareness. And awareness means recognizing both the benefits of different financial services and products and the risks and the costs. And there I think both sort of mandatory transparency norms, which are obviously nice to talk about, but very difficult to design and implement. But I think that's certainly something that the regulators should be focused on. and two, very strong customer protection or consumer protection, which is that the consequences of mis-selling or inadequate communication have to fall to an extent on the service provider, that you can't get into a situation where there are no consequences to sort of, in a sense, if not cheating, then certainly misleading the customer. And I think these are two aspects which are clearly coming up in the post-crisis regulatory debate, where earlier sort of consumer protection was seen as a larger issue to be addressed from the overall consumer protection perspective, not specifically aimed at it's a refrigerator or a derivative, you have the same set of rules that apply. And now that perspective has changed. I think there is a recognition that you need to have a dedicated channel of consumer protection for financial service products. So it's not something that should be seen as adversarial between the industry and the regulator. I think it has to be seen as a cooperative process, because it's also in the interests of the business to have this. If people stop trusting financial services or products, you're undermining both the development role of these activities and the commercial viability of these activities. And I think both are things that we cannot afford. So it has to be seen as a cooperative process.
Olivia, I have a follow-on question for you. Clearly, the emerging markets cannot be decoupled from the rest of the developed markets. How does the emerging markets deal with the risks of getting more and more financially integrated with the developed world and the shocks, as we've talked about in that sense? How do you manage the capital, Olivia?
But this is for me.
Yes, do you have sorry.
I think this question is better directed to the academics and the policymakers.
Sure, and Andrew, you have?
Well, the people need to understand the micro to a large extent is similar to the macro. I mean, it's not exact one-to-one match, but it's like investing, right? You would want your core savings to be put into relatively mature, relatively safe, steady returns that at least beats inflation, right? And gives you a real rate of return, and then you would then spread a certain amount into, depending on your risk appetite, into options or areas that give you high returns. So, and the trouble is that emerging markets' current policy strategy has in the past been able to tell the pension funds, you just finance the government. Now, if the government is very, 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 very good and actually invests in long-term infrastructure, that's fine, but if it uses it into fiscal deficits, then you have as Subir says, the crowding out problem. So you get, people have not thought about this policy. Let me give you a simple illustration. The Japanese are the highest savers in the world, right? They save, the pension funds are the flip side of the 230% of GDP government debt market. So it looks fantastic. I have a huge amount of savings, but the 230% of GDP pays an interest rate, weighted average of less than 1%. And a lot of them is at 10-year bonds. Guess what will happen if the interest rate go from 1% to 2%? Now, a rule of thumb is that if you go long-term, it deflates in half. So the question is that the traditional view that you invest in government securities, and government securities are AAA and very safe, is that in the Greek case, a lot of people lost their savings. Okay?
Right.
So if you put it very simply, the investing in government securities is like an old man like me who's trying to say the left hand of an old man can rescue my right hand. That's the logic of a pension fund completely invested in a domestic pension scheme, right? Government securities. So what essentially you really need to think about is that you as an emerging market investor, as your savings grow, you should invest overseas. But even in investing in overseas, which is what we've done, investing in AAA, what we thought was AAA bonds, now are at a bubble level, I mean a very, very high risk level. And if your domestic currency then appreciates, and the estimate for emerging markets is that for every 10% of surplus countries in Asia who have large FX surplus, every 10% increase in the exchange rate, they lose 5% of their GDP because of the stock loss in purchasing power of their large foreign exchange reserves. So you have this, big macro problem of the surplus economies not knowing what to do. Okay?
Diversification.
Sorry?
Diversification.
Yeah. So the diversification is necessary. But then where do you diversify?
Emerging markets.
But emerging markets are
I think
very shallow.
Most of the foreign reserves are invested in US Treasury, which is why you're depreciating,
I
right?
totally agree with you. But the problem is that a lot of the emerging markets in Southeast Asia, for example, are relatively shallow. And so a large amount of money cannot go into them without causing problems, right? So you actually get into this, sort of catch-22 situation. If you want to take the funds from the big players, your market can't take it.
But you're talking about just secondaries market, but you can invest in primary market. You can invest in private equity. You can invest in corporate bonds. You can invest in direct investments in equity, direct unpublicly listed equities. These are all diversification.
No, I agree with you, but in a lot of the markets in Asia, they are relatively small. So if you have a lot of money coming in, they can't take it, right?
We've seen that in India.
We've seen this. We see this in Malaysia. You see this in Thailand. You see this in 0.001% of your fund would swamp some of these markets.
We're not that big, and I have to say that actually we have seen our emerging market portfolio grow. We have seen an increase in the average size of ticket that we can write to emerging market companies, and I think it's a very hopeful and promising place to invest.
No, I totally support your view, but the point is, you see, this is for some of us who come from the emerging markets. We know this, right? Even myself, I'm investing my own pension. There are certain markets which just don't have liquidity. You can easily go in, but you can't get out, or at least you can't get out without large liquidity losses, discounts.
Yes. Okay.
So this is what we mean. This is the whole purpose of this panel. How do you develop the secondary market players to the institution funds, right? So if you have, for example, like in Singapore or in Malaysia, you have very large pension funds. Now, if the foreigner wants to exit, not a problem. The pension fund just takes it out, right? But if you don't have that, then when the foreigners leave the market, there's a huge crash.
So sometimes it's just a matter of actually creating them. I mean, GIC, Temasek, employees, provident pension, they're all created out of the blue. So did CIC.
Sure.
So there has to be a government initiative to create completely commercially oriented pension and long-term investor domestically to support your capital markets. In China, previously, insurance companies are not allowed to invest in the equity markets at all. Or actually now they're opened up 5–10% of their book can be invested. This is still a very conservative, very small amount. How do you actually loosen up the regulations to create, and actually not to interfere with their investment decisions, allow them to be completely commercially run, are key to actually creating a very domestically self-sustained long-term investor base so that your own capital markets can prosper without outside participation, hopefully in the future.
Okay, we'll open it up for flow participation. Any questions? Please state your name, which organization you belong to, and who you'd like to direct your question to. I think we'll be
There
able
we go.
to. Yeah, thank you.
Switch it on helps. It was a fascinating discussion. Thank you. I have a question for Subir.
Sorry, name.
Yeah, Alan Rosling. I'm the chairman of Kiran Energy, solar power infrastructure company. We have a $1 trillion infrastructure need in India in 5 years, and we don't have the domestic market to supply that long-term fixed-rate rupee-denominated capital. We're saying that mainly we're financing with banks, which makes no sense. Overseas, as we've heard from Andrew and others, there's a yield crisis. There is money looking for investment. And we're not able to bridge this gap for various reasons. I am told your former colleagues in the RBI have an issue with rupee-denominated corporate bonds for infrastructure placed outside India, in the Singapore market or the London market. And I don't understand that. If it is rupee-denominated, and if it's infrastructure, and if it's a corporate bond, it seems to me a solution to part of our funding requirement at limited risk for the country's foreign exchange and other financial stability considerations. Is there a logic to the RBI's conservatism, or is it something which one can explore constructively?
I think the basic concern that that drives this position is the loss of regulatory control. So you have rupee-denominated bonds offshore that you are not, the people who participate in it are completely outside your jurisdiction. Now, whether that is a sufficient argument to prevent it or not, I think is the judgment that needs to be made. When we're talking about the kind of asset class that is, I'm not trying to defend the RBI position, I'm just trying to lay out the concerns. When you're talking about an asset class which really has very long-term implications, where you're really looking for a particular kind of investor, now whether that is itself a pipe dream that we're going to get this kind of long-term committed money, I think there is some merit to thinking in terms of exclusion. That is, you want to bring certain kinds of investors in, and by regulating the flow through domestic quotas and so on, you have some visibility. You may not want to be exercising exclusion in a quantitative sense, but you do have some visibility on who the investors are and the kind of money they're coming in with and the kind of commitments that they're likely to make, as opposed to being completely out of control. The same kind of logic applies to the dilemma or the uneasiness on the NDF, which is the perception that because you have some degree of controls on capital account, any country that has these controls has an active NDF market. China has it, Korea has it, many other countries have NDF markets. And the worry is whether you're letting this market effectively dictate onshore, because everybody participates in that. You can be a pure speculator, you can be a hedger who finds it more efficient to hedge in those markets. And is that then having the effect of actually completely neutralizing whatever controls you might have, because you want to try and prevent this category of investors or of players, market players, from influencing your onshore outcomes? So I think that's the broad concern. So visibility and some degree of regulatory, if not control, certainly oversight, I think is the problem. Now, is that enough? Is I think the question. I think there is, from the asset class viewpoint, there is some merit to that, because you're really looking at a very specific kind of asset, and this is matched up to a very specific kind of investor category, and I think you have a better chance of bringing that together if you're doing it onshore. But that's the position.
Perhaps I could supplement that from the experience of the Asian crisis and the European crisis. Do not think that the local currency denominated bond, irrespective of issued by corporate or sovereign, cannot induce a foreign exchange crisis. Okay? This is exactly what happened, to Greece, right? I mean, Greece thought, I'm in the euro, I borrow. From an investor point of view, I'm lending, in euro to Greece. There is no foreign exchange risk. Wrong. Same currency, you owe a foreigner. When the foreigner wants it back, and if you can't deliver it, you're in deep trouble. Now, even if the foreigner does not want it back, but the foreigner wants to hedge, you're in deep trouble. I'll give you a simple illustration. The foreigner invests, let's say $100 million in your local market into a power plant, that's for argument's sake. It's denominated in local currency. The minute there is some concern, now it may not even be due to this country itself. I mean, I'm not, the local country. But let's say external interest rates rise for whatever reason, right? What happens to the value of your domestic bond in domestic currency? It actually declines. So what then you do is you do a hedge. What is a hedge? A hedge is that you sell the domestic currency to hedge against the currency devaluing or the bond. And what is it? It's actually a borrowing from a domestic bank in local currency who then goes to the central bank and asks for reserves back. So actually, the actual behavior of the foreign direct investor or foreign portfolio investor, that hedging exercise itself will draw down your reserves. And when the central bank cannot give you the reserves at that particular point of time, exactly that was the Asian crisis. The currency collapses and a huge confidence crisis occurred. And that's also what happened in Europe. That explains the caution of Asian central banks to build up large reserves because they cannot control the very large inflow-outflow and the leverage position of carry trades.
Hi, name's Anupam Khanna. I'm with NASSCOM, the IT Industry Association. The last question and the last part of the panel discussion prompted this question. Andrew and I actually shared a boss who used to always say, remember, the financial system, this is in the World Bank, is a subset of the economic system. And the last part of your discussion eventually said you need a primary asset base that needs to be financed, and that's where the crux of the matter lies. Subir sort of mentioned that you can finance infrastructure in countries such as India or even corporates, given the present system, through bonds. I beg to differ. For 20, 30 years, we've been trying to say that develop the bond markets. The fact is, when you have the nature of risks, is either policy risk or execution risk or fundamental governance risk, as we have in the corporate sector, it's impossible to develop bond markets except on very, very shaky foundations. So at that stage, you end up either going to banks who are unable, unless they become very vulnerable, or you have to go to specialized financial entities, much like Brazil did, or I think China did. If you think back how China financed its infrastructure, it was specialized financial entities. So how do you think countries like India can avoid doing that?
Andrew, Subir, any?
I think, Anupam, the context in which bond markets are seen as a solution, I think you walked a little late, perhaps, or I don't know if you heard the early part of my. There is a context, and I think that context has to be appreciated as a critical requirement for the development of bond markets. I talked generally about macroeconomic stability and some market development. You're bringing in the additional dimension of governance and credibility, which I certainly don't disagree with. But when you're talking of alternative channels, what you perhaps gain from specialized institutions, we've had our experience with specialized institutions, and there are mixed outcomes there also. So it's not that one is a perfect substitute for the other in any context. I think we have to look at bond markets as a way to broaden both the pool of funds that is being tapped, particularly when it comes to having created the demand channels, the domestic investor base, and somewhat a more effective way of diversifying or spreading the risk over the system, within limits, of course, because then you can get into the extreme sort of moral hazard problem which we've seen in the crisis. But I don't think it's an either or. I think specialized institutions play a role, will always play a role, but you cannot afford to concentrate risk in specialized institutions. I think when you're talking about too big to fail, in the banking context, we also have to remember that too big to fail becomes an even greater problem when the nature of the risk is concentrated, when you have exposures to a very narrow set of sectors, all of which are subject to the same sort of larger environmental risks. So an infrastructure finance entity, for example, essentially becomes a public entity because the government is essentially going to say, look, we can't afford this, afford to have this institution fail, so we have to provide fully for its survival, which then takes it on effectively on the government balance sheet, which of course doesn't exist on paper, only in concept. And then you're talking about financing it through government papers. So we're back to square one. If the government's borrowing heavily to finance consumption, it simply does not have the role to finance it doesn't have the room to finance investment, and it's back to square one. The funding constraint becomes binding. So I think we've got to look at it in terms of a complementarity, that there are certain activities that can clearly be financed by specialized institutions, where the knowledge, particularly the sector knowledge issue is important. I don't know if infrastructure now has any such space, but we can't ignore the contribution or the importance of bond markets in this. And rather than sort of saying that, look, the environment is a binding constraint, I think we've got to work backwards and say if the environment is the constraint, then what do we need to do to break those boundaries? I think that's the way we need to go.
My view is that, I don't know if this has been sufficiently done in India, is that part of the infrastructure build-out responsibility has to be shifted to the private sector, and the government actually has to facilitate that private sector being able to execute and deliver on these infrastructure projects, and therefore the returns that investors are looking for. I mean, in absence of a fully formed domestic bond market, you may still have to use those specialized financial institutions in the intermediate term, such as that of the World Bank, the IFC. But even for IFC, they're looking for a return that's commercially justified. Even for long-term investors like CIC, Temasek, and GIC, we have to be able to see that these projects get completed and that they are actually properly operated. I think that a couple of years ago when I lived in India, I was told that 90% of the road projects that are undergoing were actually delayed to a great extent. So if the government cannot help provide assurance that these projects can be properly delivered, how do you develop confidence among investors to invest in the Indian infrastructure sector?
Yeah, if I could just add a point here. People seem to think that the market, by and large, works, and that the market, interest rates would reflect the risks that there are. The reason why, since the Asian crisis, we have not been able to develop, with a lot of policy support, the Asian bond market has not developed its depth, is fundamentally due to a very fundamental point, is do the bond rates reflect the underlying risks? And if they don't, that's why the investors haven't bought them, okay? I mean, that's one fundamental reality. Firstly, the rate must reflect the underlying risks. Now here, if you're an emerging market, you would begin to see this. Let me point out to you a very sad fact that is a fact of life. If the banks have no ability to discipline the borrower, you think the market has the ability to discipline the borrower? Especially if the bankruptcy laws are not quite in place, the bankruptcy courts are not quite in place, and that the market rate reflects the true rate, and that the global interest rate is in a very, very low state and a high rate of distortion. And we do not know when those rates will be adjusted. So the biggest risk to markets today is not market risk, it's policy risk. We simply don't know when the ECB, the Fed is going to reverse policy. And because if they do reverse and we're not ready for it, we're going to have a shock because we're a very small market, right? And that's a huge problem. And so therefore, actually, if you really think through it, the equity market is which is able to absorb much better shocks than the leverage, you cannot solve an over-leveraged system with more leverage, which is why I feel, in a sense, I'm not sure whether I understood Imam correctly. The advanced markets solution of QE is solving the problem.
Any further questions? Okay. I think we've, in any case, run out of time. With that, I'd like to thank Andrew, Olivia, Subir, and Inam for the valuable comments. And I hope everyone got lots of insights from what they had to say. Thank you.
Thank you. Thank you. Thank you. Well done.